Hey everyone, welcome back to Alpha Insights. I'm Kristen, and we've got a lot to unpack on one of the biggest AI stories out there.
And I'm Adam. Great to be here. And hey, if you have questions while you're listening, drop them at stockalpha.ai. We'll try to get to as many as we can.
All right, so let's talk about NVDA. The short version, they're basically the default supplier for high-end AI training and inference. GPUs, software, systems, they run the stack. Honestly, I was a bit surprised by how dominant the ecosystem has become.
Yeah, that's a good point. When you look at their software lock-in, CUDA and all the developer libraries, it raises switching costs. Hyperscalers and OEMs rely on that, so it's more than just selling chips.
Right. Their latest fiscal quarter, revenue around $68.13 billion, and net income near $39.55 billion. Those are massive numbers driven by data center GPU sales and software licensing.
And to add to that, their return on equity is through the roof, over 100%. That's a sign of huge margin leverage and capital efficiency. But the real question here is, how much of that is already priced in?
Exactly. The stock is trading around $198 per share, and valuation metrics are rich. Trailing price to earnings is about 40 times, forward price to earnings about 30 times, and price to sales is roughly 21 times. Analysts say those multiples expect continued strong growth.
So the bull case is straightforward. Continued hyperscaler demand, software recurring revenue scaling, plus new system and networking plays that widen total addressable market. Some analysts even have price targets up near $350 in an optimistic scenario.
But the bear case is real too. Supply chain or capacity missteps, stronger competition from other chip makers, or simply guidance that comes in light could compress multiples fast. Some bearish scenarios put fair values down toward $140 per share.
Short reaction.
Short reaction.
Right.
Let's dig into competitive moats and recent moves. NVIDIA's strengths are threefold: the CUDA software ecosystem, deep ties with hyperscalers and OEMs that lock in capacity, and best-in-class performance per watt in many workloads.
And they're not just selling chips anymore. They're pushing system sales, DGX and HGX systems. And they recently put about $1 billion into a strategic partnership with Nokia, which hints at moves into networking and telecom infrastructure.
That Nokia piece is interesting because it suggests they're thinking about bottlenecks beyond GPUs: power, cooling, and networking at data center scale. Analysts are watching that closely as a potential way to expand into adjacent infrastructure.
When you look at the data, the market is also watching memory and storage vendors trying to capture AI spend. It's multi-front now. Everyone from memory makers to foundries matters for the ecosystem.
On valuation, a blended analysis points to a fair value range somewhere between $230 and $290 per share under consensus growth assumptions. The analyst mean target sits around $269, which implies meaningful upside versus current levels, but that's based on continued execution.
Analyst sentiment is mostly bullish. Lots of strong buy and buy ratings. But remember, consensus can flip quickly after an earnings miss or a weaker guidance. Guidance is the immediate driver here.
Which leads us to catalysts. Earnings are coming later this month, expected around the 20th, and management commentary on data center capacity, product cadence, and software revenue recognition will drive the next big move.
Also watch for further disclosure on that Nokia stake and any roadmap for telecom or infrastructure products. And industry commentary on power and cooling. Those could become real scaling constraints for big AI deployments.
Quick note on technicals. The stock peaked near $216 in the last year and has been consolidating since. Key support levels are roughly 180 and 150, with resistance near 216 and 240.
So what's the practical takeaway? Analysts note a trade-off. Durable secular upside from AI, versus near-term valuation and execution risk. That means monitoring guidance, supply commentary, and software monetization closely.
Exactly. We're not giving advice here, just saying the market is pricing high expectations. Risk management and position sizing are the ways people talk about navigating that environment.
Interesting.
All right, let's wrap up with the key takeaways.
First, NVDA is the dominant supplier for high-performance AI compute, supported by a sticky software ecosystem.
Second, financials are strong, huge revenue and profit growth, but current valuations already bake in a lot of growth.
Third, watch the upcoming earnings, supply commentary, the Nokia investment details, and infrastructure bottleneck talk. Those will move sentiment and multiples.
Got questions? We'd love to hear from you. Head over to stockalpha.ai where you can ask us anything and we'll answer live. And while you're there, check out more market content.
Thanks for listening. I'm Adam.
And I'm Kristen. See you next time on Alpha Insights.